Hey everyone, welcome back to my channel. It is your investing coach Wahida here. This is where you can learn how to invest and build wealth even if you are the first in your family to do so. Okay, so today I want to talk about where you can put your investments. So you have your in a Roth IRA, and if you were confused about what these accounts are, go back to one of my other videos that gives you a rundown of what these retirement accounts are. But so you have your retirement account funded. Now we have to invest that money, right? So there's a multiple step process here. You fund the account, now you tell the account where to put the money so you can have it invested. So there's different strategies. There's a lot of different strategies out there on where you can invest your money. One popular one is the Swenson Portfolio Breakdown. So David Swenson is he was one of the most admired institutional investors. And this was because he grew Yale's endowment from $1.3 billion in the 1980s to over $30 billion over his 35 years that he was there at Yale. So this investment approach is now being used by a lot of universities for endowments and foundations, and it's known as the Yale model. And from this, we can also take a lot of lessons as well as retail investors, as everyday investors, like you and me. Here you can see the breakdown, the asset allocation that David Swenson used at Yale. So the asset allocation is essentially the spread of investments over various areas. So at first glance, you can see that the asset allocation is pretty diverse. So we've got 6 different categories here. Let's go over them one at a time. So you can see from the breakdown, the first on the list is US stocks. So he puts 30% into US stocks. So these are companies that are based in the US. So your companies like Amazon, Google, Microsoft, and it can range from like all of the companies in the US, or depending, let's say there is room for kind of interpretation, right? You can like go from like maybe just the largest companies in the US or all of the companies in the US. And then he puts 15% into foreign developed stocks. So these are countries outside of the US that are developed countries outside of the US. So it's countries like Japan, France, Australia. So companies based in those developed countries outside of the US. And then he puts 15% into emerging markets stocks. So these are companies based in emerging market countries. So these are countries like Brazil, India, Russia. And then he puts 20% into REITs. So REITs are cool because it's a way you can invest in real estate without having to buy a physical property. So you can choose to invest in REIT funds that focus on different types of properties. So essentially it's a lower barrier of entry for you to own real estate without having to buy a whole big, like a full home and like deal with the maintenance and deal with like renting it out and becoming a landlord. With a REIT, you can put money into a fund, and they kind of focus on what type. There's different focuses on like the types of properties that you can invest in, or if you're looking for income versus growth from that fund. So there's flexibility there. David puts 15% into US Treasury bonds and US Treasury inflation protected securities. So these are essentially bonds that are seen as essentially a more safe investment. And now, since we have an idea of like what the breakdown is, now where can we, like what funds can we put the investments into, right? So here you can see I just took I pulled funds from Fidelity and Vanguard, just so you can have an option to so you can see the variety. So none of this is investment advice. It's really just so you can see the different options there are out there. So if we were wanting to follow the Swenson breakdown of the Yale model, and if you're doing it in Fidelity or Vanguard, here you can find that breakdown here. So for US stocks, we have for Fidelity, the Fidelity Zero Total Market Index Fund. So this is essentially investing in the entire US stock market. And then there's a Vanguard version as well, the Vanguard Total Stock Market ETF. And for you'll see that for my Fidelity options, I put in all index funds. And it's because there isn't a minimum that you have to invest. But for Vanguard, I put in more of the ETF options, the exchange traded funds option. And that's because the ETFs have no minimum investments. But for Vanguard, for their index funds, a lot of their index funds have a minimum investment of like $3,000, so that can get quite expensive if you don't have like a big capital to start investing in with. For the foreign developed stocks, we have the Fidelity International Index Fund, and then Vanguard's version is the Vanguard ETSE Developed Markets ETF. For the emerging market stocks that we put 5% in, Fidelity's version is the Fidelity Emerging Market Index Fund, and then Vanguard has the Vanguard Emerging Markets ETF. So if you can see on the end, I put the ticker symbol there, so you can kind of type in the ticker symbol onto the platform's search bar, and then you can see it and learn more about it, and even buy it if you have an account there. And then for the REITs, we have the Fidelity Real Estate Index Fund, so ticker symbol is FSRNX, and on the Vanguard side is the Vanguard Real Estate ETF, or VNQ. For the US Treasury bond, Fidelity has the Fidelity Intermediate Treasury Bond Index Fund, and then Vanguard has the Vanguard Intermediate Term Treasury ETF. And then for the US Treasury Inflation Protection Securities, Vanguard has the Fidelity Inflation Protected Bond Index Fund, and then the Vanguard platform has a Vanguard Short-Term Inflation Protected Securities ETF. All right, so now that we have an idea of where to put the money, we now have to think about how our asset allocation changes as we get closer to needing that money. So our time horizon, as our time horizon gets shorter, how we invest our money changes. And that's because the longer time horizon, the longer time when that's available where you don't need to have access to that money, right? Think maybe your retirement, right? Maybe you've got 30 years before you're retiring. If you have a long horizon, time horizon, you want to invest pretty aggressively, because when you're investing in stocks and equities, that's when there's going to be the most room for growth. And then as you get closer to your time horizon, so as you get closer to needing your money, you want to become a little bit more safer with your investments. So you switch from less stocks and more bonds, because bonds are seen as a safer investment. Okay, so a recommendation by Jack Bogle, and Jack Bogle is the founder of Vanguard and he was a very renowned investor as well. He recommends to figure out your stock allocation, your any time period. You can take 100 and minus your age, and that will be your stock allocation. So if you're 30 years old today, let's do the math. You take 100 minus 30, and that will equal 70. So that means you would put 70% of your investments into stocks, and then 30% of your investments into bonds. And then actually, if you kind of take a look at the Swenson breakdown, it is pretty much right now like a 70% stock breakdown, like equity breakdown, and 30% bond breakdown. So as you get closer to your the time that you need your target date, essentially, you're wanting to become a little bit more conservative in your investments. So you can see maybe in like 10 years, your stock breakdown will be 60% and your bonds breakdown will be 40%. So you kind of just adjust your percentages of how you're investing your portfolio. All right, and just as a reminder, none of this information is investment advice. It's really just for you to get educational knowledge so you become a more confident investor. If you're wanting more personalized information and personalized plans, this is when you would reach out to like a financial advisor so they can look at your information on a case-by-case basis. All right, and with that, thanks everyone. Come back again every week for new videos, and I hope to see you soon. Bye.